Hello and welcome to our discussion on the accounting for investments, and in this discussion we will try to understand the effect of investment in associate companies and subsidiary companies. So subsidiary company is one where the parent or the acquirer has a control on financial and operational issues, and that we for the time being assume that happens through the acquisition of more than 50% shares in the subsidiary. The associate company, where the parent company has no control but has an influence in the financial and the operational decisions, and for that we can assume that the investment is within 20 to 50% shares of the other company. So let us take an example to understand that. So this is an example where A is the acquirer, has an investments in B, C and D, and this balance sheet already shows the investments, so it's a standalone balance sheet of A. After the acquisition of shares, 250 of B, 800 of C and 900 of D. So now we are going to see that A in this case is required to prepare the consolidated balance sheet because it has a subsidiary in the form of C. So in the preparation of subsidiary consolidated balance sheet, what will be the treatment of the assets and liabilities of B, C and D is the focus of our discussion. Let us transfer this to the Excel sheet. Let us remove these items and rework on that. So therefore, if A is having a subsidiary in the form of C, so let us see this number of shares and shares acquired. Okay, A is shares, A is stake in the first case. Okay, in B is 250, in C 800 and D 900. So the stake acquired is 9%, 9%. Then in case of the other two, 25% and 89% stake in, okay, 89%. Maybe for the sake of we can make this 810. Okay, 810. So therefore it becomes exactly 90% stake in. So that means C is a subsidiary of A, B is the associate of A, and D is just an investment. So let us make the change here too. So this is 810. Okay. So when C is the subsidiary, since A is having at least one subsidiary, it is required to prepare a consolidated balance sheet, and the consolidated balance sheet requires information about the goodwill and the minority interest. Let us calculate the goodwill and minority interest. The purchase consideration is already given, 44,000. So equity of C, since the fair value or any other information is not given, we assume that the fair value is the value given in the books, so 37,000, and A's share is 90% of that. So is 90% of that. The balance is the minority interest. So therefore, purchase consideration minus the proportionate equity is the goodwill. So in this case, the goodwill is 9,900. And so let us start working on the consolidated balance sheet. So the consolidated balance sheet will show the assets and liabilities of A plus the assets and liabilities of C. No change in the capital, no change in the reserves, minority interest will appear, then cash of both A and C, inventories of A and C, plant of A and C will appear, and C's shares will not appear on the balance sheet because it is consolidated. However, the excess money paid, goodwill, will be recorded. So goodwill and minority interest are the result of consolidating assets and liabilities of C. Now let us see what happened to the B share. B's investment or investment of A in B is only to the extent of 25%. So therefore B is an associate, so A has to follow equity method of accounting. The equity method of accounting says the investment in the associate will be shown in the consolidated balance sheet to reflect the equity of B on the date of the balance sheet. So B's equity is 10 plus reserves, and of this A's share is 0.25, so 10,500. So the change in the value of investment, the investment value has come down to 10,500, or the value has changed by negative 4,500. So B's investment will be now shown as 15,000 plus minus the change here 10,500, and that corresponding changes, since no other reserves are given, we make the adjustment into the reserves. Okay, so the reserves have come down because of the changes in the value of investment, And D, in case of D, the A stake is only 9%, so it is neither an subsidiary nor an associate, so D's shares will continue to appear. Okay, D's share will continue to appear, assuming the market value has not changed, so D's share will continue to appear at the same amount. So in case of a consolidated balance sheet of A, the assets and liabilities of C are consolidated because C is a subsidiary company, B is an associate company. There are no consolidation required, but they have to follow the equity accounting. Equity accounting means the value of the investment will be adjusted to the changes in the value of the equity of B. So therefore the changes in equity of B will be adjusted to the reserves, okay, and whereas in case of D's shares, D is neither an associate nor a subsidiary, so D will appear as it is. So the goodwill is because of the subsidiary company, the minority interest is because of the subsidiary company, the value of the associate company changes to reflect the equity of B, and the corresponding changes will be shown in the reserves of the company. To summarize this, so investments of A, B is an associate company having 20% share, C is a subsidiary company because it's 90% stake, and D is neither an associate nor a subsidiary. So in the consolidated balance sheet of A, consolidation is required because they have one subsidiary. So investment of B will be shown by using the equity method of accounting. The assets and liabilities of C will be consolidated. As a result, there will be minority interest and goodwill, and D's share will be just shown as an investment. So this exercise summarizes the treatment of investment in subsidiary, investment in associate, and investment in other company which is neither an associate nor a subsidiary.